In today's session, we will discuss the lease accounting from the lessee's perspective. We will start with the subsequent measurement of the finance lease. The question is, what each periodic lease payment of a finance lease is composed of?
Each periodic lease payment made by lessee has two components: 1. The interest expense, and 2. The reduction of lease liability.
I will postpone my next question until you clarify the difference between an ordinary annuity and an annuity due.
Well, an ordinary annuity is a series of regular payments made at the end of each period. In an annuity due, by contrast, payments are made at the beginning of each period.
Please tell us about the impact, if any, on the reduction of lease liability if the lease payment is made at the beginning of each period.
If the first periodic lease payment is made at the commencement date of the lease, in an annuity due, its only component is the reduction of the lease liability. In other words, the first payment equals the reduction of the lease liability. No interest expense is recognized for the first payment because no time has elapsed between the lease commencement date and payment.
How interest expense is calculated?
Interest expense is calculated using the effective interest method, also known as the effective rate method or interest method. It is calculated as the carrying amount of the lease liability at the beginning of the period times the discount rate of the lease. In an equation form, interest expense equals lease liability at the beginning of the period multiplied by the discount rate.
How the reduction of the lease liability is defined?
The reduction of the lease liability is the excess of the periodic lease payment over the interest expense recognized during the period. In an equation form, reduction in lease liability equals lease periodic payment minus interest expense.
Please give an example of how to calculate interest expense and to amortize the lease liability.
Okay. On January 1st, year 1, Salawi Abdel Fattah Company S&A entered into a 3-year lease of a machine from a lessor. S&A must pay to the lessor 3 annual payments of $100,000 starting from December 31st, year 1. The machine useful life from the lease commencement date is 5 years. The lease agreement allows S&A the option to purchase the machine at the end of the lease term for $15,000. S&A is reasonably certain to exercise the purchase option. S&A incremental borrowing rate is 15%, but rate implicit in the lease is 10%, which is known to S&A, the lessee. The present value factor of an ordinary annuity at 10% for 3 periods is 2.48685 to be used for the rental payment, and the present value of 1 at 10% for 3 periods is 0.7513 to be used for the purchase option. The present value factor of an ordinary annuity at 15% for 3 periods is 2.28323, and the present value of 1 at 15% for 3 periods is 0.65752.
Based on the above example, please explain to the members how to calculate the interest expense and to how to amortize the lease liability.
First of all, the lease liability has to be calculated at the lease commencement date. Although the lease term is less than 75% of the leased asset remaining economic life at the commencement of the lease term required to be classified as a finance lease, yet the lease is a finance lease because it meets the lease classification criterion of including a purchase option that the lessee is reasonably certain to exercise. The rate implicit in the lease of 10% is used to calculate the present value (PV) of the lease payments because S&A, the lessee, knows this rate. The lease liability is calculated as follows. 1. The PV of rental payment equals $248,685, being $100,000, the annual rental payment, multiplied by 2.48685 plus 2. The PV of purchase option equals $11,270, being $15,000, purchase option price, multiplied by 0.7513. Thus, the PV of lease payments is $259,955, being $248,685 plus $11,270. The journal entry to be made is debit right of use asset for $259,955 and credit to lease liability for $259,955. Following this stage, an amortization schedule of the lease liability has to be prepared.
Please explain how to prepare the amortization schedule of the lease liability for the 3 years lease term. Detailing each year calculation is preferred.
For each of the 3 years of the lease term, the amount of the lease liability at the beginning of the year, the effective interest rate, the interest expense for the year, the cash payment for the year, the reduction of the lease liability, and the lease liability at the end of the year should be shown in the lease liability amortization schedule. For year 1, the lease liability at the beginning of the year of $259,955 is multiplied by 10%, the effective interest rate, to arrive at the interest expense of the year of $25,995. The reduction of the lease liability of $74,005 is arrived at by subtracting the interest expense of $25,995 from the annual payment of $100,000. The lease liability at the end of the year of $185,950 is arrived at by subtracting the reduction of the lease liability from the lease liability at the beginning of the year, $259,955 minus $74,005. Note that the lease liability balance at the end of year 1 is the lease liability at beginning of year 2. Upon the payment by the lessee, the following journal entry is made: debit interest expense for $25,995, debit lease liability for $74,005, and credit cash for $100,000.
Please go ahead with the year 2 calculation.
For year 2, the lease liability at the beginning of the year of $185,950 is multiplied by 10%, the effective interest rate, to arrive at the interest expense of $18,595. The reduction of the lease liability of $81,405 is arrived at by subtracting interest expense of $18,595 from the annual payment of $100,000. The lease liability at the end of the year of $104,545 is arrived at by subtracting the reduction of the lease liability from the lease liability at the beginning of the year, $185,950 minus $81,405. Note that the lease liability at the end of year 2 is the lease liability at the beginning of the year 3. Upon payment by the lessee, the following journal entry is made: debit interest expense for $18,595, debit lease liability for $81,405, and credit cash for $100,000.
Please go ahead with the year 3 calculation.
For year 3, the lease liability at the beginning of the year of $104,545 is multiplied by 10%, the effective interest rate, to arrive at the interest expense of $10,455. The reduction of the lease liability of $104,545 is arrived at by subtracting interest expense of $10,455 from the payment made in year 3 of $115,000, $100,000 for rental payment plus $15,000 for purchase option exercised. The lease liability at the end of the year of 0 balance is arrived at by subtracting the reduction of the lease liability of $104,545 from the lease liability at the beginning of the year of $104,545. Upon payment by the lessee, the following entry is made: debit interest expense for $10,455, debit lease liability for $104,545, and credit cash for $115,000.
We understand that the present value of lease payments of $259,955 plus total interest expense of $55,045, being $25,995 plus $18,595 plus $10,455 equals the total payments under the lease of $315,000. The session is up. We will continue to discuss this accounting standard in the coming sessions. Thank you.